Federal Reserve officials have chosen to maintain interest rates at their current level, a decision made in order to allow policymakers more time to evaluate the effectiveness of the interest rate increases implemented over the past 18 months in combating inflation. While interest rates remain unchanged, the Federal Reserve has presented a fresh set of economic projections that indicate an expectation of another rate increase before the conclusion of 2023. Additionally, these projections suggest that borrowing costs will likely remain higher in 2024 than initially anticipated. This decision and outlook reflect the Federal Reserve's optimism about the economy's resilience and their commitment to addressing inflation. Federal Reserve Chair Jerome H. Powell emphasized that the decision is based on the unexpectedly strong performance of economic activity. Since March 2022, the Federal Reserve has already substantially raised interest rates to cool the economy and curb inflation. This week, they maintained rates within a range of 5.25 to 5.5%, marking the highest level in 22 years. Further rate increases are expected before the year concludes, with a target rate of 5.6%. While initial expectations were that borrowing costs would be lowered to 4.6% by 2024, the revised projections indicate a decrease to only 5.1% in the following year. Overall, these decisions reflect an economy that continues to perform well, with strong growth, lower unemployment, and slower inflation anticipated at the close of 2023. This positive outlook suggests that the economy is effectively managing higher borrowing costs without approaching a recession, while inflation is gradually receding from its previous rapid pace. These factors afford the Federal Reserve the patience and flexibility needed to navigate price increases without causing significant economic disruption. The current economic landscape has been likened to a Goldilocks scenario, with a deceleration in inflation accompanied by minimal adverse economic effects. Despite the tightening of monetary policy, the economy has not exhibited the anticipated slowdown. By maintaining the possibility of another rate increase later in the year, the Federal Reserve remains prepared to address any lingering inflationary risks. While inflation appears to be moderating, uncertainties persist, which could lead to further rate adjustments in the coming months. The Federal Reserve's schedule includes meetings in early November and mid-December, allowing for flexibility in responding to evolving economic conditions.